Hello, it is the 9th of October 2012. It's a Tuesday. Within this video, we'll start off within the daily chart of silver. Then I want to go over the upper and lower bands, explain them a little bit, go over some historical charts. 2011 Dow Jones, a couple from 1929 and 1930 on the Dow as well. And then I want to go over this 2006 chart of silver, as well as some comments the NFL player Eric Winston made yesterday, I think it was. And I'm going to be talking mainly about the economy within the situation. So that'll be the order of the video. I've already done this before. Playing around with the sound. I'm hoping that the sound is good on this, as I'm just trying to talk louder, even though the sound volume is only somewhat low. And let's get started. Within this, there's not much to go over. I mean, it's really in the sideways consolidation. This is the second consecutive day that it has been below this lower band, which is the last time that has occurred in here. The last time it has had two consecutive closes below it in here. And I meant that on the 18 average band, of course. So what I'm looking for, just look for signs, message of the market, always adjust it here in the now, because it's always going to make changes or at least confirm what you've expected kind of deal. But let's just assume you see a situation where it comes down to here, and then maybe it finds resistance either back at this previous support or any lower higher within the band that starts to decline, and then it goes lower, maybe back down to the low 33s again. Then I would be expecting a move of 3150. So that's the type of methodology that I like to use as far as making predictions for either up moves or down moves. As far as on the breakout above this level, 37 area has been this upward band where it's been going flat for days now. Not really even down and flat for that matter. And that would be a area for resistance. Now, as far as this upper and lower band, the way it's calculated, I take the 18 average of volatility, front weighted average. The volatility is that of taken on any given day. The high minus the low divided by the low again. That's the percentage that it traded within that period. So I take that 18 front weighted average. I triple that percentage, whatever it happens to be, and that's the difference from the 18 average of highs for the upper band. It's also the exact same difference in size from the 18 average of lows as well. So that is how that works. Now, if you've watched Ira Epstein's videos regarding the Bollinger Bands, he'll talk about 95% of the time it stays within the band, and that's 2.5% on both sides, the up and down side. I've done over 100,000 data points on gold, silver, and the Dow Jones, multiple time frames, mainly the silver gold hourly charts, as well as the Dow Daily. And from what I have seen is that it stays within my bands about 99.3% of the time, so it does a very good job in that. If it happens to go above or below the band, there's about a 22% chance, maybe even closer to 25 from what I've been researching, that it will do another consecutive day of going above or below it. I've seen 8 consecutive days. That's downside on the silver hourly chart, and 70% of the time that it either goes above or below a band, it's going to be below the band. So that's the general rule of thumb within those bands. But it's also good to know that what I like about it is you come to an area where you can't get to that point, and if you barely get to it, that's good enough. As long as my eyes can see here that it's pretty much at the band, that I know. That's all I need to know. Okay, so we go sideways, back up to the band, sideways. This tells me here that it had an okay gain, but it could have been higher because it did get to the band, and of course now it's at 37. But if you take those bands out, then that could mean massive volatility, which is why I got some historical charts to go over. First one is 5 consecutive days of being below the lower band on the Dow Jones, which is the biggest or the most consecutive periods on the Dow daily chart that I've been able to figure out. And this occurred last year in 2011. Now, this is interesting because there's not many times where you can use historical data and fundamentals to predict the future of the future events. And that's what you can do here, because this occurred because of the debt ceiling debacle, or because the debt ceiling limit got so high. Now, of course, that's 100% guaranteed to exist using simple math, but they're not going to tell you that, nor are they going to let the cat out of the bag either. So because of that, if you have situations where you don't find support at the band and it keeps going lower, watch out, because quite frankly, this was the day that was the, okay, this is getting serious. We pretty much came to the band here, pierced above it, and then we broke below it here, but we got above it, and then boom, it just crashes through. This could be dangerous and deadly, and it was. So that's some of the key things to be going over when you are looking at that lower and upper band, because there's going to be times where we're going to be seeing this really both levels, up or down, especially because of the manipulation price silver has been going through, that when the time is right, that it does do its big burst. Don't be surprised if you do see it go above it for 3 or 4 days, and then of course the same thing on the reversals. Let's go back to 1928. This is a daily chart. Notice that here you got normal trading, yada yada yada, break below the 18 average, close to the band, and then up to this 18 average, which flattens out, and then boom, down she goes. All I really want to point out is that you can hit it multiple times. It did do 5 days in a row, but if you have like 2 days in a row, then maybe 3 days later, 2 more days in a row, and then 8 times over the next 80 sessions with only 1 more 2 in a row type deal, then that's pretty bad in itself as well. But you can see again, you break through the low, things get really out of control. 1930, let's do an interesting 5-day chart. This is, again, a few things I want to point out. First of all, this was pretty much all-time highs back in the day. So we can see the date on the left-hand side says close to Halloween 1928 in here. And well, the top was close to after Labor Day of 1929. So basically 11 months. Price action goes from 230 up to 386. Wow. That's pretty big. Now, no, this here was about 30 cents off on here, which is just so huge. And why I'm showing it at this point, just show some key things. You find support in here, and notice at this point in here, and even here too, it's both bullish and bearish to get a rally from here and a sell-off on here. On here, it would have been bullish if you found a higher low and then went higher, but that didn't happen. Or if you found support here and then went bullish again. Of course, for this to be bullish, it needs to maintain patterns of higher lows along the way. So in here, it basically says, no, we're not going to maintain that higher low package. Big move down below. Then you get some consolidation. You're breaking down below support and major support in here. This is telling you that because the point A to point B did not fail as of yet, that we're probably going to have another leg lower. It was a severe leg lower down to 42. Okay, let's go over some other things. This is a daily 2006 chart. And the reason why I got this up, I just made this quick just because I wanted to verify the data that I picked up as I get more silver data. And of course, interesting thing to note, this is hourly time frame. So this is how many hours or so there are in a year. But what I find interesting again is after this breakout pattern, really breaking about from this 9 point, it goes up to 15. So 6 on 9 is that of about a 67% gain. But this was after it already broke from its bottom of 5 just the year before, which was pretty close to 100% gain. So when you see gains of 30, 40% over a whatever period of time, does it look like it's up too much? But not only that, the reason why I want to show this chart is I've seen these movements so recently a lot. This reminded me a lot of the 2010-2011 run, yes. And then this reminded me of the 2011 high. You had a big move down, back up to that level, and then, of course, this was a little bit different, but you crashed down below it. Now, it's interesting, if we take Fibonacci from point A to point B, I did it quickly. It's a penny off of this 1262 or 1328 level, sorry. Just a penny off from point A to point B. I think it was either 1327 or 1329. Regardless of the fact, it's pretty much 1328. You notice you have perfect resistance. So same thing. As I'm saying now, silver goes up to 37, back down to 26, and now we're at 35. I've been saying it does not need to make a higher high to be bullish. It can, as long as it makes higher lows. That's the key thing. And this is the exact same situation. It didn't need to make a higher high above here. No. And just like here, okay, just maintain the higher lows, but at least keep this low in play. If you have any serious correction, then whatever that low happens to be has to hold. Okay, so that's good. So we have this low. We have a serious correction. That's what the low happens to be. So now when you start to go up, as long as your higher low is above here, that is what's important. But you get a situation again where you break above fib. It doesn't hold too well. But, and actually, you know what? It was 1262, I think. But either way, it shows you the bullishness. Yeah, it was 1262. Because I remember saying that you had this fake move here, which was the case. But you have a situation where you break above resistance, come back and find the higher low to here. So now you have a decent higher low. And of course, 2007 happened to be a spectacular year for silver. Finally, and I'm going to switch this over to the economic point at the end. I'm going to read this quote. Then I'm going to talk about fans' rights at sporting events, and then I'm going to switch this off to the economy. So, quote from Eric Winston, offensive tackle of the Kansas City Chiefs, who is a football player. When you cheer somebody getting knocked out, I don't care who it is, and it just so happened to be Matt Castle, end quote. For now. On the game on Sunday, quarterback Matt Castle got injured with a concussion on Sunday's game. He's not that good of a quarterback, and, well, there's at least a few or a small amount of fans, and that happened to be, I guess, cheering when he got it taken down, and then booing him as he was walking off the field. So I just want to point that out. Let's move on with the quote. It's sickening. It's 100% sickening. I've been in some rough times on some rough teams. I've never been more embarrassed in my life to play football than in that moment right there. Okay, so I'm going to go to fans' rights, and then I'm going to make a counter to this. And the fans' rights, from the way I see it anyway, and I mean, this is just my point of view, so this is his point of view, that's the way it is. You got a point of view as well. But fans' rights is they can boo and cheer whoever they want. They can wear whatever type of shirt that's pretty much appropriate. It doesn't matter. You can wear a different team. You can wear a New York Knicks jersey at a baseball game if you so choose. And that also means that within the fans, you really can't really give any verbal abuse to fans, at least nothing detrimental. But there's a fine line between the fans and the players, because for the most part, you can say pretty much what you want to the players. You can tell them to F off or any of that type of stuff. And, well, you know what? That's pretty much fine. So when I look at it, is it fine for a fan to boo or cheer those situations? Quite frankly, that's, to me, within the rules, if you will, if there is such a thing. Is it sickening? Okay, yeah, of course it's a little bit sickening, yes. But this is my counter on this. When you have a situation where 53 players on a team multiply 32 teams, that's about 1,600 players. I'm guessing the average salary is over $2 million, which is, it's just going to get out of hand how many fiat dollars are played within these sports. And then you can even move this further to entertainment. And anyone who's got these high qualities that just keeps on demanding more and more and more, especially when their industry has an increase well over 20,000% pay increase in over 20 years. But anyway, with that being said, I find it sickening, personally, 100% sickening, that many athletes have such a love or want to acquire fiat debt notes that are guaranteed to cause suffering and harm. And it gives people a lot of rough times, much rough times, because you are wanting fiat debt notes that only central banks that can create it, because they're the only ones that are allowed to create it. That means they loan it to the peoples. And the masses take the loans. The interest that is charged is guaranteed to never be paid back in the macro sense. So therefore, if you say, I'm out of debt, I paid it all off, I'm plus 10 million, well, that plus 10 million that you have is other people's debt, which is why when you look at the situation on this planet, I find it very sickening that there is a lot of human beings in the mode for wanting fiat debt notes, and I've never been more embarrassed in my life to look at the human species when what they love so much are fiat debt notes. So, Eric Winston, you may be embarrassed and sickened, but so am I. Have yourself a great day.